110. Can you believe it? Wow. Hello everyone. How are you? It is 12:30 and that means that you and I have an appointment. It's time to discuss it with Drake. And today's quick topic is going to be, what does it mean to make a principal only payment? Okay, so it's kind of a fun topic. Before we get started, remember, if you ever miss a live broadcast, all you have to do is go over to YouTube, type in Drake's Real Estate TV, hit subscribe, and you will never miss another live episode or anything that I post for that matter. So please, if you stop by, please say hello in the comments. Yes, I'm talking about you. So let's get started. You're going to hear terms about principal and interest when you get a home loan. Okay, your principal is the amount that you borrow for your home loan, and the interest is what you pay monthly to use the loan. Simple enough, right? So to calculate the principal of a mortgage, you'd subtract your down payment from the final sales price of the home you're buying, and the principal that you borrow starts accumulating interest right when you take it out. So your interest payment is the second part of your monthly mortgage payment because you're paying your mortgage lender to give you a loan, which is reflected in your interest. So most lenders will calculate the mortgage rate in terms of an annual percentage rate or APR, and that is what you pay on your loan per year in interest. So for instance, if you borrow $200,000 and your APR is 5%, you're paying about $10,000 a year in interest. Okay, your principal, of course, is high at the start of your loan. So during this time, your monthly payment is primarily going towards paying your interest. A few percentage points of interest significantly actually affect how much you are ultimately paying for your loan. For example, if you borrowed $150,000 and your interest rate on the 30-year loan was 4%, your monthly payment would be around $716. But if you had the same loan at a 6% interest rate, your monthly payment actually jumps more to like $899. So there's a big difference. So when you make a payment on your loan, your lender will apply part of your payment to your interest rate and fees before reducing the principal. So the lender will actually use the same formula to pay the interest if you make additional monthly payments. The lender actually adds up interest accrued during the month, using a part of your payment to pay for the accrued interest before it's then, of course, applied to your principal. So what is a principal-only payment? Well, a principal-only payment is going entirely toward reducing your principal. And since the amount of interest you pay is based on the principal, your interest charges are smaller when you reduce your principal. You can pay off debt faster with principal-only payments and save on interest. So not all lenders will allow a principal-only payment, and some lenders will actually let you make additional payments during the month. But you need to specify that it should go toward only the principal. So regarding a home loan, if you're making additional principal payments, that's supplementary and applied directly to your principal mortgage amount, which goes beyond your actual scheduled monthly payment. So your monthly payments stay the same no matter how many principal-only payments you make. You will only save money in interest throughout the life of your loan, which of course is a great thing. So you might want to actually recast your mortgage if you want lower monthly payments. So let's talk about mortgage recasting. Finally, like I said, if you want to save on your home loan, mortgage recasting can help you pay less interest costs and maybe cut down on the total number of payments that you must make before you pay your mortgage in full. So you make a lump sum towards your loan's principal balance with a mortgage recast. Your lender amortizes your mortgage, reflecting your lower balance, and you can actually lower your monthly payments because your principal went down, but your term and interest rates actually stay the same. So here's an example. Let's say someone that might want to recast the loan is someone that actually bought their new home before selling their old one. So then, once they sell their previous home, they can actually use that money to recast their new mortgage. Let's say you get a bonus or a windfall of money for some reason, you also might want to do a mortgage recast. Many lenders will actually charge a servicing fee for this, but not usually more than a few $100s. Not every lender will offer this option, and some types of loans aren't eligible. So make sure that you seek out that information from your lender. And some of them actually have a minimum payment perhaps like $5,000, but you also probably are going to need to meet equity requirements set by your lender for your payment history. So make sure you check on them. And that's actually all I have for you today. I hope you found that interesting, right? Come back next week because I want to give you more information. As always, I love coming from contribution. So I want to give a shout out to Realty Times today for providing the information that I'm giving for you today. And as always, please don't keep me secret. Share this with everyone that you know. And if there's a topic that you would like me to discuss in the future, just let me know and I'll get it on the calendar. I hope that you, yes you, have a fantastic week. And don't forget to be kind to one another. Don't forget to live, laugh, and love. And until we see each other again next week, when the next move matters, contact Drake for Homes. See you guys later.